Welcome back to Good Seed Investing. We are back and ready to go in 2025. Today, we are diving into a topic that can seem a little bit intimidating, but is packed with so much potential for you to make money in the stock market. So, if you ever wonder what options are, how they work, and if they are the right tool to add to your investing portfolio, then you are in the right place. In this video, we will introduce terminology used so that you can speak the language and explain the types of options there are. So, what is an options contract? An options contract is a financial agreement that gives you the right but not the obligation to buy or sell an asset like a stock at a specific price called the strike price before a certain expiration date. Think of it as reserving a deal for the future by paying a small fee up front known as the premium. Now, we'll go over some of these terms for better understanding in the next slide. So, there are two main options. You have your calls and your puts. A call is an option contract that gives the owner the right, but not the obligation to buy the stock at a specified price. A put is an option contract that gives the owner the right, but not the obligation to sell a stock at a specified price. Simply put, call options give you the right to buy the asset, and put options give you the right to sell the asset. Now, many people who trade options don't actually intend to buy or sell the underlying asset. Instead, they focus on collecting the premium as a way to generate income. We will talk more about trading strategies in future videos, so stay tuned for that. Some other terminology you will want to know: an expiration date. This is the date that the contract expires. Premium, the price that the options contract is trading for currently. Strike price is the price the owner of the option can buy or sell the stock. And multiplier. One option contract represents 100 shares of the underlying stock. We'll go into more details on that later on. Options chain. An options chain is a list of all available contracts for any given security. I will show an example of what this looks like later on in a Webull video, so just stay tuned and we'll actually look at something live so that you're able to see what an options chain actually looks like. Okay, the next one is bid price. The highest price a buyer will pay for a security. Ask price is the lowest price a buyer will pay for a security. It's kind of the same thing you would see if you were buying or selling stocks. The bid-ask spread is the difference between the bid and ask. So the smaller the spread, the more the liquidity of any given security. And basically liquidity, or let's say volume, is basically what that means. And it's easier to get in and out of a contract when you have more liquidity. Mid price is the average of the current bid and ask prices being quoted. So let's say the bid is at 50 and the ask is at 60, the mid price would be at 55. Next, we have what's called implied volatility, also known as IV. And this is basically the market's forecast of a likely movement in a stock price, often used to price options contracts. Low volatility equals lower premium prices and vice versa. And when we look at the options chain, we'll see this in the form of a percentage. Next, we have intrinsic value. This is what an option is actually worth if you were to exercise today. Basically, options in the money have intrinsic value. Extrinsic value is the time premium associated with the option's price. And out of the money options have extrinsic value. So what's in the money? What does that mean? Let me give you an example. So a call option with a strike price of $50 is in the money if the stock is trading at $55 because you could buy the stock for $50 and sell it for $55, making a profit. A put option, on the other hand, with a strike price of $50 is in the money if the stock is trading at $45 because you could sell the stock for $50 when it's worth $45, thus making a profit. There's also a term called out of the money, and out of the money is pretty much the opposite. So for a call option with a strike price of $50, it would be out of the money if the stock is trading at $45, because why would you pay $50 for a stock when you can buy it for $45 in the open market. Conversely, for a put option with a strike price of $50, that will be out of the money if the stock is trading at $55. Because why would you sell the stock for $50 when you can sell it for $55 in the open market? Hopefully this is making sense, and if not, please leave your questions in the comments. All right, now let's start talking about the Greeks. And no, I don't mean a sorority or a fraternity. There are 4 main Greeks that will be attached to any options contract. You have your delta, your gamma, your theta, and your vega. The delta measures option sensitivity to a change in the price of the underlying stock given a $1 move. It also measures the probability an option will end in the money. So, for example, first of all, for call options, a delta ranges anywhere from 0 to +1. So, a delta of 0.5 would mean that if the stock price increases by $1, the options price will increase by 50. And then for a put option, delta ranges from 0 to -1. And so if a delta of -0.5 were to be attached to the stock or the option, the stock price decreases by $1, the options price will increase by $50. In regards to the probability portion, a delta can also act as an approximate likelihood that the option will finish in the money at expiration. So, for example, a delta of 0.30 suggests a 30% chance. Then we have gamma. Gamma measures the rate of change of delta given a dollar move in the underlying stock. So, delta and gamma pretty much go hand in hand. Next is theta, which is essentially your time decay. This measures how much an option price will change given 1 day of passage or 1 day of expiration. And essentially, it shows the value or how much value an option loses every day as it gets closer to the expiration, assuming all else stays the same. So for theta, it's always going to be negative for buyers because options lose value over time. Theta is positive for sellers because they're collecting the premium as the option loses value. And lastly, you have your vega. This is sensitivity to volatility, measures how much an option price will change given a 1% change in volatility. Now, the 2 main ones that I use are typically going to be your delta and your theta. And as we go over more trading strategies, I will be able to explain how I use the delta and theta when I'm choosing my options contract, because you do want to make sure that you're choosing an options contract that makes sense for your trading strategy. So just to keep it simple, if you're buying a call option, you believe the stock will increase or you're bullish. And if you are buying a put option, you believe the stock price will decrease or you're bearish. Now let's look at an example of a hypothetical description of an options contract on the stock Apple and how it will read. Now, keep in mind this slide is a little bit old, so I'm using a 2024 date, but whenever you're looking at options contracts, you're always going to be looking at an expiration date in the future. So you'll have your ticker symbol, which is AAPL, which is the Apple's ticker symbol. You have your expiration date. We're using September 21st, 2024 in this particular example. Your strike price, which we have at $150. The type of option that you're trading, which will in this example be a call, and the price of the option contract, which is $5.25. Now keep in mind the $5.25 has to be multiplied by 100 because we use a multiplier when we're trading options, thus costing you $525 to purchase this particular option contract. All right, so here we have an options chain. I pulled up Webull and pulled an options chain up for the stock Apple. And as you can see, there is a whole lot of dates here. All of these dates are what we were talking about as far as your expiration dates. This will show you weekly as well as your standard expiration date. So there's weekly, not every stock has weekly expiration dates, but some of the larger ones do. And then you're going to always have your standard expiration dates, which expire every, I want to say, third Friday of the month, which would be, for instance, like your February 21st. So over here, we also show the number of days that are left until expiration. So if we're looking at the January 24th, 2025 expiration date, we have 4 days left, and so on and so forth. And that this can go all the way out for years. You know, for instance, the latest one we show is January 15th of 2027, which is 725 days out. Now, the further you go out, the higher the premiums will be for those contracts. But I just wanted to show you an example of what it looks like when you first open up an options chain. Now, typically, when I trade options, I'm trading anywhere from 30 to 45 days out. We'll talk about trading strategies in a later video. But let's just take a look at the February 21st, 2025 options chain here. And so these numbers may seem intimidating, but bear with me and I'll try to go over everything with you guys. So as we talked about in the video, we have our bid up here, we have our ask. This is the last price the option traded at. This is the percentage change. So basically the percentage that it changed, whether that went up or down from the previous trading day. The mid price, which we talked about. The implied volatility, which we can see is in percentages. This open INT stands for open interest. How many people are actually currently in that particular contract, and volume, how much has traded for that particular day as far as how many contracts have been bought or sold. Then we, of course, have our delta, gamma, and theta, our Greeks that we talked about in the video. And if I slide over here, I believe that's all that I have listed on my particular options chain. Although you can pretty much customize this and add whatever categories that you'd like. For instance, if I click here, I can take away or add certain items that I'd like to see. But I pretty much have this set for what I like to see when I'm looking at options contracts. So right now, Apple is currently trading at $229.98. Right now, the market's closed, so there's no price movement at all. But when the market's open, you'll see these numbers are constantly moving and changing as the stock price is moving as well. On your left side here, you're going to have your calls, as you can see right here. And on the right side, you're going to have your puts. So if you're looking to buy calls, you're going to stay on this side of the options chain. And if you're looking to buy puts, you're going to be on this side of the options chain. And in the middle is where your strike prices are. So we have strike prices, ranging all the way down. I only have about 20 of them showing right now, but you can also adjust that right here where you can show more or less or all of the options that are available. 20 or 30 is good enough, typically. And essentially, when you are looking at this, you want to look at it from a perspective of, okay, where is the stock price trading? And which strike prices are in the money or out of the money. So if I'm on the call side, anything up here would be considered in the money. And if I'm on the put side, anything down here would be considered in the money. You're looking at, for a 230 strike price, the last price that it traded at was about $7.65, which again, we multiply that by 100, which means the last price was $765 that somebody bought the options contract for. You're asking your bid, again, is where you're looking at what they're willing to buy the contract for and what someone's willing to sell the contract for. And you want to make sure that you have, like I said, a lot of volume and open interest. And Apple is one of those stocks that has lots of volume. It trades, millions and millions of shares a day. And that also trickles into the stock options for that. And again, your delta, as we can see, this particular one at the 230 strike is at a 0.53 delta. When we're looking at that as far as probability, that's a 53% chance that it will be in the money by expiration. And then when we're looking at the theta, it's a 0.10, so it's not fairly big. but that's also going to be a measurement of how much time decay will happen in regards to the stock losing value. On the other side, which is your put side, we're looking at the last price that the options sold at was at $7, which again, multiplying that by $100 would be $700. And we can see that the puts have actually been losing value. If you look here, pretty much everything's negative in red. And on the call side, we're kind of seeing some premium change on the positive side. And some of these contracts have been gaining premium. If you're looking at implied volatility, again, the higher the volatility, the higher the premiums, and the lower the volatility, the lower the premiums. And as you can see, higher the volatility, higher the price. Lower the volatility, lower the price. This is going to look the same no matter which date of expiration. So if I swap that out and went into, say, a June 20th, 2025, you'll see that the same strike price actually is going to cost me a lot more. Looks like about $1,600 because I'm getting more time to allow the stock price to reach that particular strike. So this is just a small overview of what an options chain looks like. If you're using Charles Schwab or Robinhood or any of the other brokerages, they're going to all pretty much look similar with slight variations, but you're always going to be seeing expiration dates. Your strike prices and your calls are going to be on your left, and your puts are going to be on your right. Like I said, we will have more videos where we're going over trading strategies, and when we do that, I'll be able to get into the weeds of the numbers and selecting certain strike prices, etc. But I wanted to just give you a visual so that you guys were aware of what an options chain actually looks like. So there you have it. As always, thank you for watching. Please like, share, and subscribe if you haven't already. And look out for more videos coming soon on various option trading strategies that will help you be profitable in the market. Until next time, be blessed and happy trading.